Should you invest in fixed maturity plans? That's the topic of discussion in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. To answer all the questions that I have is the CEO of Value Research, Dhirendra Kumar. Dhirendra, we welcome you.
Thank you.
My first question. FMPs don't usually come into the limelight with the AUM of roughly about 1 trillion. They're quite popular amongst the investors. But what is actually the FMPs, if you were to define it?
It's a fund, and it's a closed-end fund. And it is a closed-end fund which invests only in fixed income securities. And it is a closed-end fund with a term. That is how closed-end funds are, that they open, a new fund is launched, people invest money, they invest money with a time frame because it has a term. It's normally above 3 years. So FMPs are able to give you a slightly more predictable return, because if you launch a closed-end fund which invests only in fixed income securities, then the fund manager will buy bonds of that maturity. And the yield on those maturity, the return on those maturity is fairly predictable. And they are insulated from the interest rate risk. What happens typically in a bond fund is that when interest rates go up, the bond prices fall. And when interest rates go down, bond prices go up. And that is bad so that leads to the unpredictability. And when this happens, whenever there's a change in the outlook of fixed income, the interest rate, then investors act. Investors pull out money if interest rates are going up. Investors invest money if interest rates are likely to go down. And that creates a lot of flux. That creates a lot of, uncertainty. And fund managers are forced to act. In this case, fund companies raise money for a predictable time frame, and they are able to deliver predictable return. And it is meant for fixed, risk-averse investors, the bank depositors. They are also the advantage of FMP is that they are able to give you predictable return, unlike an open-ended fund. They are also able to give you slightly higher return. It is also more tax efficient because 3-year time frame, interest from bank deposit is taxable. If you invest in an open-end fund, the returns could be variable, could be volatile. In this case, because of the time frame, you are able to do the indexation.
So it's like a lock-in period.
It is a lock-in period. Okay. It is a lock-in period, and there is no way you can actually take the money out. So it is low on liquidity. If you are likely to need the money in between, then FMP may not be for you.
So as you said, it reduces the risk of interest rate volatility.
Yes.
So that's a big plus.
That's a big plus, because if an investor, because that interest rate volatility is not unreal. It is not that if you are an investor in an open-end fund, it is not that if you stay invested you will get the return, because other investors will act, because other investors will pull out if interest rates go up, because other investors will put more money if interest rates go down. So your return gets affected even if you are a long-term investor. So if you are looking for predictable return, also because predictable return, FMPs are great. Another thing which is a plus for FMP is that because the fund manager is taking a defined call that in 3.5 years he must get his interest and principal back, so he's able to take he's able to take a view. And in between, whatever happens, even if NAV goes down, it doesn't matter to the investor, because at the end he will get that much money because other investors will not be working. And because of this time frame, fund managers are able to take a credit call, which sometimes enhances return.
So what I've understood is that the returns are still indicative. It is not guaranteed.
Oh, of course not. No mutual fund offers you a guaranteed return.
Right.
It is just that it is indicative. If the fund is going to invest in 3.5-year corporate bond, you know that what these bonds are yielding. Then you know that what the expense of this fund will be.
Okay.
So you could be so you can actually predict it, and your prediction will be right, because there is not much of a. Of course, there could be a. There is only one possibility that some credit blows up. The fund invests in a bond and doesn't get the principal or interest on time. In that case, the fund will take a hit. but most funds are able to mitigate that risk with diversification.
Okay.
And not too many FMPs have faced this problem.
How would you compare them to the bank fixed deposits?
More tax efficient, less liquid.
Okay, fine. There must be some negatives also?
Yeah, less liquid, because
Less
you can't
liquid,
take,
okay.
because
Okay.
bank fixed deposit, you can always take a premature encashment.
And there's hardly any volume to trade also.
FMPs don't trade.
Don't.
They are technically supposed to get listed, but they don't trade. So you have to compromise on liquidity. If you want the money, there is a small chance that you need the money in between. FMPs may not be for you.
So are there a viable solution for investors who are suffering from falling yields, as you said, on the bank FDs?
They are interesting option. They are useful option for investors looking for risk averse investors.
Okay.
Who don't want to take any market risk, who also don't want to take any big credit risk, or the interest rate risk. That apart, you want marginally higher return, but these funds are, even FMPs are not good enough to combat inflation. They will give you a little more return than bank deposit. They will also give you more tax efficient return.
Okay.
And it comes with a compromise on liquidity. But that apart, it is not in a position to beat the fixed income, beat the inflation by a wide margin so that your money grows in real terms. No, it will be marginally higher.
Okay. So my next question is that, okay, if I'm an investor, so what kind of an investor would you define who should take up the FMPs?
Very conservative investors,
Okay.
Who don't want to see their principal go down in value. The investors who are bank depositors, and they don't want to, they are not prepared for any assumption of any risk. It is meant only for them.
Okay. So is there anything in particular that an investor should see before buying? Are there any do's and don'ts to it?
One is that you really can't see, because in FMPs, because they are closed-end funds, so when you invest in a fund, the fund does not have, it is not carrying a portfolio. Unlike an open-end fund, that that your money is getting invested in a fund which looks like this. This is only a promise that it will look more like this. So only one, investors should look at two things: how the FMPs of the fund company has done in the past, their track record of the previous one, because you can never invest in a FMP with a track record. They are closed-end, they start, and you have to invest at the outset. And the other thing is that what is the stated policy of going down the credit quality? Is the fund saying that it will invest a lot of money in lower rated credits, lower rated bonds? If that is so, avoid those. Don't assume, don't put your principal at stake for marginally higher return. That is, you err on the side of caution. So just be a little careful. Don't choose a fund, don't choose an FMP which has a stated policy of investing a substantially large amount in lower rated, bonds with lower credit rating.
So it's important that they have the scheme info document. They must read that carefully.
They read that carefully and look at that policy.
Okay. So invest in FMPs if you want higher returns, if you want tax efficient fund, tax efficiency.
Tax efficiency, because, lower taxation.
However, keep in mind that they are low on liquidity and there is hardly any volume to trade.